Look at your last credit card statement. The interest line, whatever number is sitting there, now multiply it by 12. Then multiply that by 30. That number you just got is your retirement, or what should have been your retirement. The credit card industry already cashed it. You signed it over every time you carried a balance. 21% annual percentage rate, compounded daily, on groceries you ate 2 months ago, on gas that already left your tank, on a dinner that ended 6 weeks before the statement arrived. The Federal Reserve confirms the average household carries $7,886 in credit card debt. That balance costs $1,759 a year in interest alone. Not principal, just interest. Money that vanishes every 12 months and never comes back. The Amish solved this problem 150 years ago with $2 worth of paper. The fix exists. You will never see it advertised on television, because no company makes money when you stop borrowing. Let me show you what they buried, what it costs at any Walmart, and how to set it up tonight. The Amish are not anti-technology in the way television tells you. They are anti-debt. Roughly 80% of Amish adults do not carry a credit card. Period. Not for emergencies. Not for rewards. Not at all. When they need a vehicle that costs $15,000, they save for 3 years and pay cash. When they need a house, they pay it off in 10 years or less, sometimes faster. When they want a tool, they save the exact amount in physical currency before they walk into the store. There is an Amish bishop named Ephraim Lapp who summarized their entire financial philosophy in one line. Buy now, pay later is paying for a dead horse. You are paying interest on something that no longer exists. The food was eaten. The gas was burned. The shirt was worn out. But the debt keeps charging you 21% every single day. The horse is dead and the bill keeps coming. That is what every credit card balance actually is. A graveyard of dead horses charging you rent on memories of meals you forgot you ordered. Stop. There are 3 things I cannot fit into this video, and they are the difference between borrowing for life and retiring with money in the bank. The exact category breakdown the Amish use to allocate every dollar of monthly income across food, fuel, shelter, savings, and emergency reserves before a single bill arrives. The compound interest table that shows what your $7,886 balance becomes after 30 years of minimum payments. Most people are off by a factor of 5. And the step-by-step transition plan to move from credit-dependent spending to a fully cash-based household in 90 days without missing a single recurring bill, mortgage payment, or auto draft. It is all in the suppressed file, step by step, numbers verified, categories laid out. Scan the QR code on your screen or hit the first link in the description and get it now. Let me keep going. The system has a name, envelope budgeting. It predates the internet. It predates online banking. It predates Dave Ramsey by generations. The Amish were doing it when Lincoln was alive. A pack of 100 paper envelopes costs about $2 at any Walmart, Target, or Dollar Tree. You write categories on each one. Groceries, gas, utilities, eating out, clothing, emergency fund, savings. Still watching? That means you already understand what the credit card industry hopes you never figure out for yourself. The $2 fix is in the suppressed file, the one the financial industry hates the most because it costs them billions if it spreads. Scan the QR code on your screen or hit the first link in the description and get it now. Now stay with me. The math gets worse before it gets better. On payday, you withdraw the cash and you divide it into the envelopes by hand. When the envelope is empty, that category is closed for the month. No exceptions. No mental math about what you can afford. The envelope tells you. The envelope is the budget. The envelope cannot lie about how much you have left. A study by Prelec and Duncan Simester at MIT in 2001 showed people consistently spend significantly more when paying by card than by cash. In some categories, the difference was double. The pain of paying is lower when the transaction is abstract. That is not an accident. That is the entire business model of every plastic card in your wallet. Tap, swipe, insert chip. Each motion engineered to remove friction, each motion engineered to bypass the part of your brain that knows the money is real. Cash restores that friction instantly. The moment you have to count out $20 bills for a $40 lunch, your brain does the math your card never made you do. The moment that friction comes back, the average household stops bleeding. $300 to $700 a month they did not know they were losing. Take the $1,759 a year the average household pays in credit card interest, invested instead at a 7% average return. Over 30 years, that single redirected number becomes approximately $166,000. That is a retirement. That is the difference between Social Security only and Social Security plus a paid-for house and a buffer for medical bills. That is the cost of plastic. Not the card, the interest. Compounded against you instead of for you. Now consider the minimum payment trap. At 21% APR, paying only the standard 2% minimum on a $7,800 balance, you will be making payments for 30 plus years. You will pay back roughly 3 times what you originally borrowed. The credit card industry calls this responsible repayment. It is the most profitable arrangement they ever invented. The general purpose credit card was launched by Bank of America in 1958. Before that, household debt as a percentage of income was a fraction of what it is now. The Consumer Financial Protection Bureau reported that credit card companies collected $130 billion in interest and fees from American consumers in a single recent year. $105 billion of that was pure interest. $25 billion was fees. That is not a market. That is a transfer of wealth from working households to four major banks. The Amish opted out of that transfer in the 1800s. They never opted back in. And here is what the data shows about the result of that opt-out. Amish small businesses have a survival rate of approximately 95%, according to research by Eric Wesner, compared to roughly 50% for non-Amish startups. The reason is not religion, the reason is debt. They never carry it into the business. Every expansion is paid for in cash. Every piece of equipment is owned outright. When a recession hits and credit dries up, they do not notice. They never depended on credit in the first place. The Amish also operate without traditional insurance. They use mutual aid. The community covers catastrophic losses through pooled contributions called Amish Aid. A barn burns down. The community rebuilds it. No premium, no deductible, no bank involved. Strip away the buggies and the suspenders, and what you have is the most financially resilient subculture in the United States. You can do the same thing. Not the buggy, not the suspenders, not the language, just the financial principle. Pay yourself before the bank. Allocate every dollar before you spend a single one. Put the cash in the envelope before the month begins. And when the envelope is empty, you stop. Step 1. Buy the envelopes, $2, any major retailer. Today. Step 2. List your monthly take-home pay. The actual number that lands in the account after taxes. Step 3. List every fixed bill that comes out automatically. Rent or mortgage, utilities, insurance, internet. Step 4. Subtract the fixed bills from the take-home pay. What remains is the variable spending budget. Step 5. Divide that remaining number across categories with realistic percentages. Groceries, gas, discretionary, emergency fund, savings. Step 6. Withdraw that variable amount in physical cash on payday. Divide it into the envelopes immediately. Step 7. When you go shopping, you take only the relevant envelope. When the envelope is empty, the trip ends. That is the system. There is nothing more to it. The Amish have used it for 150 years. Every personal finance system worth following since then has been a digital reskin of this exact mechanism. And let me be honest about what this is and what it is not, because the financial industry will weaponize anything left vague. This will not fix a medical bankruptcy. This will not undo a mortgage you cannot afford. This will not make $8 an hour into a living wage. What it will do is stop the bleeding. Most people in credit card debt are not there because of one catastrophic event. They are there because of 1,000 small purchases that the plastic made invisible. Coffee, lunch, a subscription auto-renewing in the background, a convenience fee on a delivery app, each one painless on the card, each one compounding at 21%, each one stealing from a future that has not happened yet. Every fix on this channel follows the same pattern. A problem that costs thousands, a material that costs $2, and a reason no one taught you. Because when the problem disappears, the invoices disappear too. The financial industry needs your debt to exist. Your retirement does not require their cooperation. It requires you opting out of a system designed to extract $130 billion a year from households like yours. Drop a comment below with the year you got your first credit card and an honest estimate of how much you think you have paid the banks in interest since that day. Most people are off by a factor of 10. The math is brutal but worth running. Take your average monthly interest charge, multiply by 12, multiply by the number of years you have carried a balance. That number is what the financial industry collected from you for the privilege of spending money you already had in the first place. And if a friend is drowning in credit card debt right now, share this video with them. $2 worth of paper envelopes and an honest household budget have pulled people out of holes that bankruptcy lawyers told them were permanent. If this video changed how you look at that piece of plastic in your wallet, hit subscribe and the bell. Because the next file the financial industry hates is already being prepared. The Amish were right 150 years ago. They are still right today. The $2 fix exists. They just made sure you would never find it.